Hello, and welcome to the December 2022 monthly market update. My name is Ryan Flanders, and I'm the Chief Investment Officer here at the Flanders Group. November was another good month for financial markets, extending the bounce that we saw in October. And for the first time since the summer of 2021, the S&P 500 posted consecutive positive months, and the U.S. indices all showed single-digit gains. But the biggest gains were found abroad, with both developed and emerging markets up by double digits. Fixed income had a strong month as well. And the key driver behind last month's continued rebound was increasing optimism that the Fed will slow its pace of future rate increases. Over much of the past year, we were faced with increased chances of higher than expected rate hikes, which in turn pushed the markets lower. We're now observing the opposite reaction, and the markets are responding appropriately. For the first time in a while, inflation dropped across the board last month. As energy costs pulled back, the housing market showed signs of slowing, and other prices cooled as well. Even Fed Chair Powell, in a speech on the last day of November, acknowledged that the pace of rate increases was likely to slow, and could be as early as the December meeting. And rates responded as expected. The U.S. Treasury 10-year yield significantly declined from over 4% at the beginning of November to about 3.7% by month's end. And lower rates typically mean higher stock and bond prices, and that's just what we saw. Despite the improvement in inflation, though, we also saw indications that the economy continues to grow. Business confidence remains solid. Corporate earnings, while growing at a slower rate than we've seen recently, did still continue to grow and beat expectations again last quarter. Job growth also remains healthy, driving increases in both personal income and spending. So at this point, the Fed's policies are working. Inflation is slowing, and so far at least, they haven't derailed growth. And much like in October, this combination is good for markets. Lower fears on rates, plus better than expected earnings, benefited the markets twice over. That said, though, there are still risks in play as we close out 2022. Inflation could certainly come back, and the Fed could risk overshooting with its policy, which could cause the economy to begin to contract. And of course, risks outside of the U.S., including Ukraine and China, still remain very real. So we're certainly not out of the storm yet. But despite the headlines, last month's continued rebound suggests many of the risks appear to be priced into the markets already, as the fundamentals, job growth, spending, and corporate earnings continue to beat expectations. And sound fundamentals tend to keep the downside risks more contained, which is where we are right now. And that's the bottom line. The downside risks are real, but we're gradually moving past many of them into more positive territory. We've talked about it most of this year, but it's worth repeating. Market turbulence is normal, and what we're experiencing right now is just that. It's very normal, albeit uncomfortable market movements. But as investors, we should keep looking at our long-term goals and not these short-term market gyrations. And the long-term outlook still remains positive. That's it for this update. Thanks for watching. Join me in 2023 for the next one. We hope that you and your family have a wonderful holiday season. If you have any additional thoughts or questions, please feel free to reach out to us at the Flanders Group. Thank you.